It's another nervous day for many. The Reserve Bank is about to deliver its monthly interest rate decision. Over the past year, the RBA has been on a campaign to tame inflation, and it is showing signs of working. The official cash rate currently sits at 4.1%, already the highest level since 2012. Analysts are almost evenly poised about whether to hike rates once again to 4.35%. We've got our business team on hand for the decision. Peter Ryan is in Sydney and Alicia Barry is with me in the studio. Alicia, let's start with you. What can we expect this afternoon?
Well, Jeremy, as you flagged, economists are fairly evenly split. 16 out of 31 polled by Reuters expect the cash rate to go from 4.1% to 4.35%. The markets are betting a lower chance, 37%. I mean, look, the RBA was on the fence in June about raising rates, but inflation pushed it over the edge and it did lift the cash rate in June. Since then, we have had some data out for May. Unemployment has fallen again to 3.6%. Retail sales are up, and that inflation number, whilst the headline has eased quite drastically, the core is very sticky. So the number that strips out volatile items, 6.5 to 6.4%, still well away from the RBA's target range. And Phil Lowe, the RBA governor, has said many times that the RBA will do whatever it takes to bring down inflation, and he's also flagged concerns about rising wages. So I am in the camp with those 16 economists that think we will get a rate hike today, purely based on the fact that pausing is not going to stop another rate rise in the future. So why wait when the objective is to bring down inflation?
Let's bring in senior business correspondent Peter Ryan. Peter, what are you expecting to happen this afternoon?
Well, Jeremy, to borrow some of the Reserve Bank's jargon, this is going to be yet another finely balanced decision, as it was back in June when the RBA surprised a lot of people by raising the cash rate to 4.1%. Just looking at a couple of the arguments which Alicia summed up very neatly, we've got inflation, headline inflation down to 5.6%. The point is it's still well above the RBA's target of 2 to 3%. And also, as Alicia noted, the RBA doesn't really look at headline inflation, it looks at that underlying inflation that strips out those volatile items like fuel, food, petrol, holiday travel. The case for pausing, well, there have been 12 rate rises already. Maybe the work's been done. It's very much a lagging indicator. Maybe it's time now for the Reserve Bank to stand back and assess the environment. So, but when you consider that house prices have risen for 4 months in a row, you've still got inflation very high. We know that if the Reserve Bank doesn't move today, they'll be moving in August or September. They're going to keep going until they get inflation back down. So it does appear, I'm pretty sure it looks as though they will be forced to push the rates button this afternoon to 4.35%.
Peter, we're expecting that decision to come out in exactly 1 minute and 45 seconds from now, so I will interrupt you as you're talking. But how much has changed for us in the past month since the last Reserve Bank decision?
Well, a lot's been going on in the world, Jeremy. We've still got the war in Ukraine going on. That's been keeping energy prices pretty high, but there is sign that some fuel prices, for example, are coming down. We're seeing inflation around the world coming down. We're seeing that happen here in Australia and in the United States. The point is this going to be a trend, or is that 5.6% headline inflation that we saw here in Australia, is that going to be an aberration, a one-off? That's what the Reserve Bank is worried, that inflation becoming entrenched in the psychology of consumers and businesses. And basically the sad truth is the Reserve Bank wants people to stop spending so they can slow the economy just to the brink of a recession, and that's what many economists are worried about. 50-50 chance of a recession, the RBA keeps going, and that's the most likely outcome at the moment.
But when we look across the economy, Peter, we're already seeing signs of deep difficulty in some sectors of the economy, aren't we?
Yeah, that's right. Mortgage stress on the rise, people worried about potentially defaulting on their loans, having to take out second jobs or working more overtime, worried about what's going to happen when fixed rate loans expire and people face a higher rates world. So there's an enormous amount of pain coming down the line.
Peter, thank you. Alicia, you're sitting on that decision coming through any moment now. They are very, very punctual with pressing the publish button on that decision, but a lot of people are going to be watching what happens this afternoon and whether those rates go up or not.
Yeah, absolutely. And it's just come out, Jeremy, the RBA has probably surprised many people with a decision to keep rates on hold at 4.1%, putting both mine and Peter's forecasts to shame. But look, it would have been a very closely, as Peter said, finely balanced decision. I mean, in any case, rates are still at their highest level since 2012. We're still seeing the fastest rate hiking cycle since the late 80s, if not on record. And we can show you how quickly rates have gone up through this rate cycle, despite the fact that the RBA has stayed on hold. Today, you can just see how quickly they've shot up. Even in previous years when they've come down, it has been a stepped approach. That is a straight line higher. But look, a slight reprieve, I suppose, for people who are paying a mortgage or battling with higher rents as a result of rate rises being passed on. I'm going to bring in now Rate City's Research Director, Sally Tyndall, who joins me from the studio. Sally Tyndall, a bit of a reprieve from, I guess, increases to mortgage repayments, but people are still suffering out there with mortgage stress.
Absolutely, Alicia. You know, borrowers around the country will be breathing a sigh of relief at this news just minutes ago, but really they should still expect further rate hikes to come. The inflation, especially when you look at core inflation, is still way too high. There is a long way for the RBA to get that back into the target band of 2 to 3%. So while we've got a breather for 1 month, this will just give households time to catch up on their monthly repayments. There's a 2 to 3 month lag between when a cash rate goes up and when your monthly repayments go up. And so, you know, 1 month's breathe might not be enough for many households.
Yeah, and as you say, mortgage stress is really starting to hit households, even as the economy is showing some signs of resilience. I mean, retail sales jumped in May, the unemployment rate's quite low, but it's a mixed picture out there, isn't it?
Oh, absolutely. Money in the bank from households, that's, you know, money in term deposits, savings accounts, transaction accounts and offset accounts, that just hit a new record high of $1.38 trillion. What a huge buffer for us to collectively fall back on. But the problem is that buffer is not spread evenly. Some people are still spending at the shops, as you say. Other households are wondering how on earth they're going to pay for food or their electricity bill when it next rolls in, because that will be higher once again.
And I mean, when it comes to getting some relief, refinancing is providing relief for some, but not everyone is in a position to do so.
No, they're not. People that have borrowed in the last couple of years and borrowed at capacity, they borrowed every last cent that they possibly could, that the bank would allow them to. They are likely to be feeling the heat the most from these rate hikes, but they're also likely to be in what we call mortgage prison, because they can't refinance to a new lender because they don't pass the stress test at significantly higher rates. However, there has been movements in this area. Westpac, CBA, they've both announced that they will re-stress test refinances in their borrowing capacity at a buffer of just 1%. The buffer is usually 3%. They've dropped it by 2% to 1% for those refinances in mortgage prison, provided that they've got a good track record of paying down their debt. So there is a window of opportunity out of mortgage prison for these borrowers.
And Sally, I'm just seeing what the RBA has said. Its decision to hold rates steady this month provides the board with more time to assess the state of the economy. When we do see the RBA pause, is it likely we might see more activity when it comes to borrowing?
Look, we could, but the problem is that every time the RBA hikes the cash rate, and you've got to remember there's already been 12, that really crunches people's borrowing capacity. So the average household has seen the maximum amount that they can borrow from the bank drop by around $200,000, if not more, in the space of 14 months. What is defying gravity at this moment, though, is the property market. Prices keep going up, despite the fact that people's people's maximum borrowing capacity has been shredded, and that's really due to a lack of stock.
And I suppose when the RBA is going to take the time to assess the impact of these 12 rate rises, the bulk of the remainder of the fixed rate mortgages are rolling off this year, so the full impact hasn't been felt yet.
It hasn't. There's still plenty of borrowers out there on fixed rates that are under 2%, if you can believe that. When they do finally come off that fixed rate, they're likely to see their revert rate in the 7s. That's a 65% increase in their biggest monthly expense, which is typically their mortgage repayments, if they do nothing. The key, though, for those borrowers is don't do nothing. Do something about it. At the very least, haggle with your existing bank or try and refinance to a much lower rate. We've still got, around 9 lenders offering rates under 5.5% still, if you can believe that.
The other people that may be benefiting today, we can't forget savers.
Oh, savings rates have really, risen it up to the banks that are the market leaders in this area have really risen to the challenge of passing on these rate hikes in full. We've got 3 banks offering 5.5% as an ongoing savings rate. That is fantastic to see. Yet, a lot of banks are picking and choosing which savings accounts get a boost and which miss out. As a result, you've still got some Big 4 bank customers earning ongoing savings rates of just 1.1%. 1.1% when the cash rate is 4.1%. I mean, that is ridiculous. Complacent savers really need to give their account a health check and have a look around for some better options.
Sally Tyndall, great advice as always. Thank you.
Thanks, Alicia.
So, Jeremy, 4 percentage points worth of rate rises since May last year, but a reprieve for borrowers for this month at least.
All right, Alicia, I'll give you a moment to check in on how the rest of the market is performing in response to this announcement. Let's bring Peter Ryan back in. Peter, you've had some time to pore over the statement from the Reserve Bank. What has the board had to say?
Well, Jeremy, we go right to the final paragraph of Philip Lowe's statement. It's still pretty hawkish, but not as hawkish as the previous statements that we've seen. And the board saying that some further monetary tightening might be required in the coming months. In other words, more interest rate rises. It's going to depend on the impact on the economy, the global economy, but they remain resolute to do whatever it takes to get inflation back down into that 2 to 3% target band. The statement from Philip Lowe makes the point that they believe inflation has peaked. They're going to have to be monitoring how quickly the fall continues, noting that interest rates, or the RBA's cash rate, has risen by 4 percentage points since May last year. Remember, back then, before that May decision, the cash rate was close to 0.1%. So it's been an incredible shock from the economy coming up from, near zero levels. But also that, as we were saying before, they want time to stand back, assess the landscape, see whether the lag of these 12 interest rate rises to date are making the impact that they require, whether they're seeing that those rate hikes are working, that the economy is slowing. And once again, Philip Lowe refers once again to this narrow path that he wants to get the economy through this, bring the inflation rate down between 2 and 3%, and not sacrifice the jobless rate. Although RBA Deputy Governor Michelle Bullock has made the point a few weeks ago that she thinks that the unemployment rate needs to rise to 4.5% to bring inflation down, and unfortunately that will or would come at the cost of potentially hundreds of thousands of jobs.
Peter, does the decision today to leave interest rates on hold make it a greater certainty that rates would be risen as soon as August and September?
It's sounding as though it just depends on what the data is. At the end of July the 26th, we'll be seeing the latest quarterly CPI or consumer inflation data. That's going to be critical because unlike the new monthly readings, the quarterly data assesses a much wider or deeper range of consumer goods in that basket. The monthly one is much more narrow. So that July 26th reading is going to be critical. Also, any other readings on employment, building approvals. Anything that's coming in is going to be critical for the Reserve Bank in determining when or if they need to raise rates. It does appear, though, that while today is a reprieve, August is probably looking more likely, but as I said, it just depends on that trajectory of inflation and whether it actually could rise from 5.6 that we had in May, given that these numbers are so volatile. Hopes are that the trend will be downwards, as we're seeing in other parts of the world, but this is the narrow path that Philip Lowe's referring to.
How long does it take for the impacts of these successive rate rises to come through? Because we're not just talking about the most recent interest rate rise, we're talking about a cumulative, more than a year of interest rate rises to take into account here and their impact on the economy.
Well, this is a really big factor, and it's not even months we're talking about. It could be as long as a year before the full impact of these cumulative rate rises really start to hit the economy. And remember that during the pandemic, people sitting at home, not able to go anywhere or do anything, built up very big buffers on their mortgages in terms of repayments. And people have been doing okay out of that, seeing that the equity they've built up in their loans has been able to assist them with these higher rates. That is for people who've took out mortgages several years ago, not just recent ones. But those buffers are narrowing. Philip Lowe's said earlier this year there were buffers of something like $200 billion, but surely they are narrowing at the moment, and households are looking at their budget, sitting around the kitchen table, working out what they can afford to do without, what they might have to sacrifice. And this is where it's really starting to hit, where even for people who might be doing quite well with paying down their mortgage, they'd be feeling the psychological effect of the pressure from rate rises, people around them, people having to make very hard decisions about their families. And on top of that, everyone knows someone who's paying well over the odds for rent, which is entirely crazy at the moment. So there are so many headwinds in society at the moment, not just interest rates, but an uncertain world, and so many of the normal rules have been thrown out the window.
One of the effects of those headwinds and hitting the brakes this hard, Peter, is the prospect of recession. It's a big, bad, dirty word, and it has been raised as a prospect coming up in the next few months. What shape is the economy in right now?
Well, the majority of market economists see a 50-50 chance of a recession by the end of the year, or maybe in the first quarter of next year, simply because of the impact of these rate rises and efforts to slow the economy. Reserve Bank forecasts and official Treasury forecasts see the economy slowing perhaps as slow as 1.5% by the end of the year. That's starting to get pretty close to flatlining. Of course, you need 2 consecutive quarters of negative economic growth, or the economy going backwards, for a technical recession. But what we also look at is what's known as potentially a per capita recession, where individuals or households are going backwards, and that's because of the high levels of household debt in Australia. That is another measurement. It's not the technical or official measure that we use here in Australia, but we all know people, whether it's our own family or other people, who are doing it very hard at the moment, and they feel their own personal budgets going backwards, and for them it's their own small recession.
Peter Ryan, always good to have your analysis with us. Thank you for being with us. Let's return to Alicia Barry now. Alicia, how are the markets reacting?
Well, as you would expect, Jeremy, given that the RBA has kept rates on hold, the Australian dollar has fallen against the greenback by around 1/3%. It's currently sitting at around 66.5 US cents. Prior to the decision, it was closer to 66.8 US cents. And that is really just as traders digest the fact that rates haven't gone up as many would have been expecting. For the market, it's the converse situation, which is typical, and it has bounced back after being around 0.1% lower heading into this decision. It's now up just over 0.5%. The ASX 200 index sitting at 7,285 points. Markets tend not to like high interest rates and have been very used to, in previous years, very low interest rates, because obviously it makes borrowing money to invest cheaper.
Alicia, thank you very much.